Housing starts are in, and you're not going to like the number. It was estimated to be up 0.2%. It's down 4%. In fact, a significant miss. And actually, last month also was revised. The number initially reported was 0.9% down. It's now 1.8% down. So disappointing. Building permits are up for both the revisions last month as well as this month. But that's I think, a clear miss, 4% down in housing starts.
Well, and joining us now is Stephen Stanley of Amherst Pierpont, chief economist, Darrel Cronk of Wells Fargo Investment Institute, still with us as well. Stephen, what is your key takeaway from these numbers?
Well, housing starts have been in a pretty narrow range this year. This kind of at the bottom end of that range. I say it's somewhat encouraging that building permits were actually up. So, maybe that there was some temporary delays or whatever. But I think the broader issue is that the housing market has just been kind of flatlining for quite some time, and a bit surprising given how strong the consumer is. People are, household formation has picked up, and yet we're not building the homes to fulfill that demand.
Okay, to illustrate what Stephen was just saying, we'll put up a chart here, actually, that has been updated for the most recent numbers showing the 4% down. You can see that's 3 months in a row of somewhat mild declines. It's been up and down, Darrel, but it's also surprising given what's going on with mortgages. I mean, it's pretty cheap to get a mortgage these days.
It is, but I think there's good and bad here. Number one, this is high-frequency data that we need to watch closely with the consumer, right? It's a serious look at a possible dent in consumers' willingness to spend. Recall, though, that we didn't see the big swoon down in rates until August. This is July data. So we're just not at the point you would expect a little bit of lift back or revision back, perhaps in August. Overall, the housing market still, I think, remains relatively strong, although a little bit pricey. Stephen can probably attest to that.
Stephen, as an economist, you get this high-frequency data every single day. As you sort of digest here, overall, what is it? You say the housing market feels strong, the consumer feels strong. Does this sort of reaffirm that view, or are you starting to see some cracks?
Well, I mean, obviously the housing starts data at the margin are on the weak side, but certainly, the retail sales numbers that we got yesterday, huge reaffirmation in the strength of the consumer. And I think the economy right now is in an unusual spot where you've got a consumer that's as strong as they've been in years, and yet the business sector is quite weak, and understandably, because people are just sitting on their hands waiting to see how the trade situation is going to pan out.
Right.
Okay, so we had Neela Richardson on, who's something of an expert in this area recently, from Edward Jones, and this is what she had to say about where the housing market is, Darrel.
The housing market I would describe as stable, but it's underperforming. Housing has led the economy both into and out of recession. This housing market isn't playing the same role it's done historically. It's not the leader in terms of the economic path as it has been in the past.
Well, that, Darrel, is exactly my question, because as we're trying to figure out whether the bond market is telling us something about a recession, do we pay attention to housing? Neela says in the past that was true, you had to pay attention to it, not so much anymore.
Yeah, I think Neela's right on this, which is housing plays a very important role, obviously, and for the wealth effect, right, stock market and your home prices, from how do people feel from a sentiment and confidence standpoint. But I think the real issue here is there's a dearth of supply in housing. We have housing formation, and new homes have not kept up with population growth at this point. So therefore, we're not going in like we did in '07, where there was both leverage in the housing market and in the system, and an oversupply of homes that we had back then. It's a completely different housing market today.
So talk to us about that housing formation, because as a millennial, I've delayed getting married, I've delayed having a family, I've delayed building that family, and in part we were sort of being blamed for why we weren't seeing a faster improvement in the housing market. You have a great chart here that we're showing about the rise of household formation finally picking up, but then housing starts aren't keeping up with it. Why?
Yeah, I think there's a combination of factors. I think builders are probably still pretty conservative. Many of them probably, the ones that didn't go under during the crisis certainly probably came close. I think the labor situation is a big problem. Builders talk about that they just can't find the skilled labor to build homes. I think the fixed cost of building have risen a lot. The cost of procuring land, of getting the zoning, and putting in all the utilities for a new neighborhood. So I think there are a variety of reasons. And I think that the consumer tastes have changed. I mean, I think more people are interested in apartments or condos, perhaps, rather than the typical single-family home with a picket fence and a yard. So there's been some adjustment on that front as well. But yeah, it is a bit of a mystery. You would think that housing starts would be 100,000, 200,000 stronger than they have been this year.
So, Darrel, that suggests two possibilities. Normally, in a properly functioning market, when you see a chart like what Stephen just had, you'd say the market's going to correct itself because the price of houses will go up and therefore people will build more houses and it'll correct itself. Or has there been a more fundamental change in taste that actually would say that we're not going to have it come back?
Probably both, right? I think if you look at some of the large metropolitan areas, prices look a little overextended in many places at this point, and in fact have been coming down. But I also think, to Stephen's good point, there's this demand for urban core, right? You've got the millennials who want to live in the urban core, and you've got the baby boomers who are retiring and want to move back to the urban core for all the arts and entertainment and convenience factors and stuff. So there hasn't been as much demand and appeal for that 2-3 bedroom picket fence house out in the suburbs that there was in prior generations. So it's a change in demand.
You know, you talked about how the labor is expensive, and that's part of the reason why we're not getting back to the levels we were. I argue maybe Jay Powell disagrees. If we're not only doing a one mid-cycle adjustment, but if we are embarking on an easy cycle, perhaps he's assuming the labor market still has some slack in it. So why the difference?
Yeah, well, I mean, I think in the construction area, it's a particular issue, which is this, you need highly skilled labor, right? Which I think there were a lot of tradesmen who were laid off during the housing bust and went and found other industries, and they just haven't come back. So builders are constantly complaining that they can't find people to put on their crews. It's not just a matter of someone being able to hit a nail with a hammer. These are people that need high skills and are not easily trained. It takes a while to train them. So I think that is an issue for the regardless of whether there's a scarcity of labor generally in the economy. It certainly seems that in the construction field, those skilled craftsmen are not